Welcome to Finance and Accounting Tutorials. My name is Peter and I will be your host in this particular tutorial. Today, I want us to look at time value of money. This is the topic that we are going to look at today, or in this particular tutorial. What is this? What does the time value of money mean? Time value simply means the value of a currency in given times. Like the value of a shilling today, that is based on the time value concept, is that a shilling today is worth more than a shilling tomorrow. What does that mean? Take for instance 1,000 shillings note. If you were to buy items 10 years ago, you would acquire several items using 1,000 shillings note. But currently, if you go to the supermarket with 1,000 shillings note, how many items can you acquire? Previously, you would have maybe purchased several items. You even need a trolley to buy items bought by 1,000 shillings. But currently, 1,000 shillings, you can even carry the items using your hands. That means the value of 1,000 based on what it would have acquired 10 years ago is less, or the value has reduced with the time. And that is basically what we mean by time value of money. That currency changes its value, that it loses value with time. Financial values and decisions can be assessed using two methods. That is the future value techniques, and also you can use the present value techniques. Future value techniques is applied to get the value of a currency today in the future. That is, if I have 1,000 shillings today, what is its value 10 years to come? And when you talk of present value techniques, this is a technique that is used to get the value of some amount in the future today. What is it worth today? Like now, if you are to be paid by someone 10 years from now, maybe someone has a loan that is supposed to pay you 10 years from now. If they are to pay you 10,000 in 10 years, what is that money worth in the current state or today? That way you use what we call the present value technique. In this tutorial, I'm specifically going to focus on the future value technique. And I've said future value is basically getting the value of a currency in some days in the future. Like if I was to give you 1,000 shillings today, how much is it worth 5 years to come? And future value techniques uses a method we call compounding. And as you can see from the definition is that future value techniques measure cash flows at some future point in time. That is the value of a currency in the future. Today's value, you try to express it in some days in the future. That is what we mean by future value techniques. If you remember, or if you go back to how we get the compound interest, this is basically accumulation of funds based on a certain interest rate. The amount keeps on growing based on the rate that it is given. So if you were to invest 100,000 today and a system that gives you compound interest of 10%, that amount will continue accumulating. That is, at the end of the year, if it is 10%, 100,000 will be 110,000 in 1 year. Then the next year it will be 110% of 110,000. So you see the amount is increasing based on that particular duration, and that is what we call compound interest. And that is the concept that we are going to apply here under future values. The general equation for calculating the future value, FV of n, is given by PV, or at times we like using P naught into the bracket 1 plus K power n. Note that the PV here or the P naught is one and the same thing, only that we like, but I prefer you use PV. I'll tell you the reason why. So in this particular case, this is when you apply the formula. You can also use the tables. We are going to see what finance tables are. I'll take you to that later. But when you are using tables, the future value of n is given by, you take the present value, or what you're calling the P naught or the PV, you multiply by the future value interest factor, Kn. Now, in the first formula, the FVN is used to stand for future value at the end of period n. So if, for example, you are investing 100,000, what is its value in 10 years, for example? That value in the 10th year is what you are calling the FVN. In this case, the n in this point here represents the period. That is the number of periods the money is left on deposit. So if you are investing 100,000 and keeping it there for the next 5 years, 5 years in this case is our N. Then the K here represents the annual rate of interest. How much are you earning from that particular account? So if you're invested in an account that pays you 10% of what you have invested, the 10% is our K. Then the PV or the P naught, this is the amount that you have invested. That is the initial principal or the present value. So if you're investing 100,000 today, that amount is what you're calling the present value, because the amount, that is the amount of money that you're keeping today so that you can earn some amount in the future. So therefore it is the PV or the P naught. Same way, when you're using tables, the FVN represent the same thing. It is basically the FVN here represent the future value at the end of period n. The PV, the P naught, we have already mentioned that it represents the principal amount or what you're investing today. Then the FVIF, this is what is unique in this particular formula, the future value interest factor, Kn. We have already seen what K is. K is simply the annual interest rate, and N is the number of periods or years that you are investing. But now, what is this FVIF? The FVIF here represents the future value of 1 shilling discounted at K%. K% here is the required rate of return, or basically that annual rate of interest that we are talking about in this particular point. Then this 1 shilling invested for a period of n, that is period n, the n here represents the number of years, the number of months, the number, how long are you investing that particular amount. And this figure, the FVIF, is normally obtained from the finance tables, which I'm going to show you later how it is determined. Having looked at that, it is good we have an illustration that is going to help us understand better the concept of future values. The illustration that we have here says, assume that you have just invested shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. Now, look at that question. I want us to find the various items or the components that we had. The shillings 100,000 here. This is what is being invested. That means this is our current amount that we are investing. And that is what we were calling the PV or the P naught. Then, when you invest, you're expecting to earn 20%. So this is our interest rate, which we called K. Then this amount of money is going to be invested for 3 years. So 3 years here represents our period N. Now let's go to solution. Let's use the formula. By the way, just to remind you, when you are calculating finance questions, always start with the formula. There is a mark for that. And it's very simple, just to write the formula. And remember, when you have a formula with you, it makes things easier for you because you only pick items and place them in the formula. It's that simple. Now, when you use this formula here, whereby we say that the future value of n is given by the present value, or what you have today, multiplied by 1 plus k power n. In our case, our present value, we have already seen it is 100,000 shillings. The interest rate, as we have seen it, is 20% or 0.2. The n is 3 years, the period under which you're going to invest. Now, how do you get the future value of these 100,000 in a period of 3 years? That's why we are putting it like FV3, the future value in 3 years. Now, the future value here in 3 years will be given by 100,000. You just replace it in this formula, and you're going to get the future value as what? Shillings 172,800. Now, let's get to the other part. Now, how do you get this value using tables? Now, I would like to introduce you to finance tables. And today, I'm specifically going to use one section of the finance tables. You find that most of the tables will normally be labeled A1, A2, A3, and A4. They are normally 4 tables, or they can use any other naming criteria, but you will have 4 tables. Now, what makes these tables different? The first thing you're supposed to check is the formula that is indicated here. It is very important. Look at this. Future value interest factor. If I take you back to our formula here, look at this. We said that to get the future value of n, you take the present value, you multiply it by the future value interest factor. So this section here is the one that is going to guide you to choose the right table. Just look at these and then look at what I'm reading here. From my table, you can check that I have FVIF. That is the future value interest factor. So I know I'm reading the right table. Now, how do you read these tables? Remember, we have what we have K, and in our case, our K was 20%. Then we have N, and in our case, N is 3. So in these tables, we have columns and we have rows. Columns run downwards. This our column looks like. Then we have rows running this direction. So this is a column, this one is a row, and this is a column. Now, what do they represent? The first row here represents the interest rate, or in percentage. That is the required rate of return. If you look at it, we have 1%, 2%, 3%, 4%, all the way to 30%. Then the first period, that is the first column here represents the duration. That is the period which that amount of money is invested. So what is the duration? In years, year 1, year 2, all the way to year 50 again, going downwards. That represents the number of years. Now, if you want to read in the table, like in our question, our K is 20%. I go to where 20% is, and it is here. Then this amount of money will be invested for 3 years. I go to where 3 years is. Then I will move like this and check that point where my point will meet with the 20%. Now check, they meet at a certain point here where we have a value 1.7280, and this is now our future value interest factor, where K is 20% and N is 3 years. That is how you read the tables. Kindly note that this section here is what guides you on which table to read. Now, having known how to read this from the table, let's now get to solving the previous question using the tables. I said earlier on that anytime you're solving a question, the formula must always come first. And this was the formula, that the future value of n is given by the present value, or the P0, which we are referring to as PV of P0, multiplied by the future value interest factor, Kn, and our K here is 20%, our N is 3%. Look at that. K 20%, N we had it at 3 years. Then the present value we already had it as 100,000. What is the present value interest factor? We have already determined that from the table, and we have seen that the present value interest factor is 1.7280. So we have the future value interest factor, that is 20%, 3 years. Then now you replace that in the formula. So when you replace that, our FV3, that the future value in 3 years, is given by 100,000 multiplied by the future value interest factor, 20%, 3 years. And note that these are subscripts. You put it below the FVIF. Then the future value in 3 years will be 100,000 multiplied by the 1.7280, which is our future value interest factor, and that gives you the future value of investing 100,000 to be 172,800. Now if you look at that, look at our solution, we are getting 172,800 when you use the tables. The same way, when we used the formula, we got the same figure, 172,800. Now I know one method might seem to be simpler than the other, but it is advisable that you know the two methods. Reason being, at times you may get required rate of returns that are not there in the table. Like if you look at this, look at the periods. The period is given 1% all the way, but you find that here a certain percentage is missing. 17% is not there. Look at this, 23% is not there. Look at this, it goes up to 30%. What if I give you 50%? Will you be able to calculate? Now, it is good to know how to use the tables. I know the tables might look simpler because you only get the values and multiply out. But also, try to know how to use the formula, because at times, some of the percentages you may be given might not be in this table. So it's good to understand how to use both methods. So having looked at that, like I said, today I wanted to look at the future value concept, and now I hope you know how to calculate the future values. I was your host for this particular tutorial. My name is Peter. This is Finance and Accounting Tutorials. Thank you very much for your time. Kindly, if you have any question or you need any clarification, or you have some advice is always accepted. You can reach me through the contact above here. This is the contact that you can get me to. Kindly subscribe to this channel and also invite your friends to subscribe to this channel so that you can be able to get future contents that we are going to share for free. That will make your study in accounting and finance more easy and enjoyable. Thank you for your time. May the Almighty God bless you. Thank you.